And what they do at that point is now they take this cap rate right here. This chart that you're seeing is a cap rate, which stands for capitalization rate. Basically meaning that if you paid cash for this property, this is the return that you would get. And then it lets you know which cap rates apply to which areas. Different markets have different cap rates, as you can see. If you're in the Southeast, you have a lower cap rate than if you are in the Midwest. And that's for obvious reasons like population and just different economic activity that makes sense for your property to cost more or less depending on where it's at. But they take the cap rate, which we're looking at the Southeast, look like they might have used this 4.55 because we're in the Southeast and this was done somewhere around that time. But you also have to take into account what tier the property is at. You have A class, B class, and C class. And then you have luxury metro and you have suburban. So it breaks down quite a bit. We're usually dealing somewhere in C class and B class. Unfortunately, in the communities that we work in, most of the properties are B class or C class, really C class, to be transparent. So the properties actually, they actually are valued a little less because of that, because of their location. So the cap rate is a little higher than right here. You get the 4.9. If it was A class, it'd be 4.5, which means that you'd be able to sell your property for more. On this particular deal, they selected the 5.8 cap rate, and then they took the 5.8 and kind of, did their calculations on the NOI from above, and that is how they came up with their 17.1. There were some things that were deducted. Rent loss, as you can see, renovation balance, and entrepreneurial profit were deducted from the 19.1 that they got from calculating the cap rate on the NOI, and then that brought it to 17.1.